Hey guys, if you click that link today, you're wanting to get some tips on what to do with a lender up here in this current market with the seller's market. And today I've got just that person for you. His name is Trey. I hope you enjoy this. We're going to talk about conventional loans. So make sure you watch through this entire video. This is going to be very informative on what you need to do and plan for when you're getting a mortgage, when you're looking to buy a home up here in Keller County. Hey guys, this is James Z with James Z Mountain Real Estate and Keller Williams Client's Choice. And I'm here today just to encourage you, if you've not already done so, make sure you subscribe to this YouTube channel. I've got content coming out weekly. It's constantly helping new folks and moving in here to the area. And we always have folks calling us constantly that are moving to the Pikes Peak region. I'm one of the realtors out here that loves working in this area. I specialize in the mountain area, specifically at Keller County, but I work basically in pretty much in the entire Pikes Peak region. So if you got any questions, you got any comments, anything that you really want to try to figure out on your own, or just by asking me questions, don't hesitate to either leave a comment. You can shoot me an email, james.dean@kw.com. You could also call me or text me, 719-304-9772. I'm here to help you, here to help inform you, educate you, so that when you come out here, you're the best prepared so that you can get into the house of your dreams when you actually move out here to the Pikes Peak region. Really hope you enjoy this. Don't forget, hit that little subscribe button down there, and you'll be able to see all these as they come up. Enjoy this video. All right, so here with Trey today, guys, to answer some lending questions that a lot of folks typically have when they're looking to buy up here in the Woodland Park area, and just to answer some basics, and hopefully this will be the start of a good series that we do. We'll just basically talk about mainly conventional stuff today. But welcome, Trey.
Thank you. Thanks for having me. I appreciate
it. Glad to have you here. Yeah, it's always a little awkward doing these. I mean, so sitting there talking to a phone, just so you guys know what we're doing right now. So in an office, yeah, hopefully you guys can get some good information out of this. So Trey's with Sierra Pacific Mortgage.
Yeah, Sierra Pacific Mortgage Company.
Yeah, and you've been a lender here for how long?
About a year now.
About a year?
Yeah.
And what are your areas that you like locally here?
I could cover the whole state of Colorado, but more specifically, Colorado Springs area, up where you're at, Teller County, anything in the surrounding Colorado Springs area.
Great. And what kind of loans do you guys typically work with?
We can do about anything your typical mortgage company can do. We do your conventional USDA, FHA, VA, any of your refinance needs.
Okay.
So we can cover just about anything you need.
Great. And today we'll be talking conventional.
Sure.
So what are some basics when somebody comes to you, because I know, just so you guys as viewers are out there and you're listening to this also, so me as the agent, a lot of times, my duties is to make sure I'm bringing qualified people to homes. So obviously qualifying them through a lender is very important before I can start showing homes, because that lets you know exactly where you're able to shop, like what price range you could be in. What price range you want to be in sometimes as well, if you don't want to be as high as you actually get qualified for, but so you know exactly what kind of payment plan you're looking at, and you can actually plan on that. So we're not just kind of going out there into a fantasy realm and looking at stuff that might not necessarily work, but we're actually looking at targeted homes that'll work for you and your family, or for your future, or whatever you want to utilize that home for. So what are some of the things that you typically ask for in a borrower when they're coming in and they're looking to get pre-qualified or pre-approved, and we can go over that.
Sure. What I'm typically looking for, we all would like to just kind of skip the pre-qualifying process, which is basically, the borrower would fill out the application, and it's basically just going off of what they put on the application to get pre-qualified. We don't have any of the supporting documents or anything like that to go along with it. So once we get the application filled out, I like to go ahead and skip ahead and get the pre-approval process started and request, your W-2s, your bank statements, tax returns if necessary, et cetera, all the different documents we need financially. And then we can kind of sift through those and make an analysis of, what kind of loan they would qualify for as far as, their max payment, kind of break it down and let people know what their monthly payments would be and things like that.
Okay. Yeah, and just so that you guys know too, because this is what I counsel my clients in as well. So, because I list homes and I also help buyers find homes, And when I'm listing a home and I'm helping sellers out, one of the conversations you always have with them is what kind of qualified buyers we have coming through the home. And what Trey just talked about there briefly, the pre-qual and the pre-approval process, that pre-qual really, I mean, the best analogy I can give to it, and it's not quite this, but it's as close as, is all those wonderful credit card pre-quals you get in the mail all the time.
Yeah.
You've not really done anything to back it up. It's just like, oh, we based on your credit pool or something else that they've got marketing wise that you should be qualified for this. But then you have to go through the whole underwriting process to actually be qualified for it. And on the mortgage side, that's the same thing. It's so it's the qualification would just be application, but then actually the pre-approval is starting the underwriting process.
Yeah, when you, like you said, the qualification, you're basically just taking a piece of paper that somebody filled out and taking their word for everything.
Yeah.
So when you move on to the pre-approval process, you've actually got the documents to support what's on the application to verify everything.
Yeah.
So it's a step farther, and it gives everybody a little more security as far as moving forward.
Yeah, especially on the seller side, because having somebody come through that's pre-approved as opposed to pre-qualified, when I've got, so I can actually go to my sellers and say, hey, this person has been through, they've got all their documentations, and all they're really waiting on is the property they're going to have under contract.
Get under contract.
And that'll finish the underwriting process. But their personal finances, they're pretty solid, basically. Whereas with the pre-qual, they might be solid, but I mean, you're really just kind of going off their word as opposed to the proof to be able to show all that stuff.
That's exactly right.
So yeah, and that's really important when you're thinking about this. And what's that typical timeline take to get that pre-approval?
A lot of times it depends on the borrower. Now the pre-qualification can take less than an hour, obviously. I mean, it can be pretty quick, but it depends on the borrower, how long it takes them to get the documents to me. If everybody's on the ball, I mean, we can have it done in 24 hours. Yeah. Yeah, it doesn't take too long at all. I mean, with the way things work these days, you know, you can verify something online, and it's very quick.
Yeah, and that helps quite a bit. So as folks come in, if you're not pre-qualified, I can get you in touch with Trey. We'll get you pre-qualified, so at least we have an idea, ballpark, and then you can start working that pre-approval. We'll start looking at homes because more than likely, if you end up finding one and you want to put an offer on it, it's probably going to be within about a 24-hour time frame anyways. But definitely making sure you've got all that paperwork and you're ready to go on that as well. That'll help you out with that process quite a bit. So, so some other things that I think are very important with a local lender, and just to be clear, Sierra Pacific Mortgage is not a local bank, but we have a local loan officer that's here that works with us.
Correct.
And some of the big things that I've seen within the real estate industry is, and I won't name names, but a lot of the larger, bigger banks. You know, and it's unfortunate because a lot of folks have like bank accounts with these big banks, especially being in a military style community that we have here. There's lots of banks that they're used to dealing with that when they move and they PCS all over the place. And that works great for checking accounts, but we have a lot of issues a lot of times getting those folks into homes with those bigger banks because they're so impersonal. And something that you're able to provide as being a local loan officer is the ability to reach out and talk after banking hours, you know, the good old 8 to 5, right? Yeah,
and weekends usually.
Yeah.
But yeah, that's one thing I really like to stress to people because, I mean, I get this all the time. You're going to get me every time you call me. I mean, when you call some of these other bigger banks, you never know who you're going to get. I mean, it's kind of a crapshoot on getting the same person every time, getting the same answer, someone that knows all about your file. So I always urge people, if you can, use somebody locally that you know you can get a hold of.
Yeah, and and everybody's regulated by the same federal regulations.
Correct.
There's no one bank that just gets to get a pass on it or anything.
No,
so.
which is a good thing these days.
Yeah, it's a very good thing. So walk us through a little bit, let's see, PMI.
Sure.
So let's discuss, because I know a lot of folks are kind of confused on that. What triggers PMI? What is PMI? And then when can they get rid of it as well?
Sure. So private mortgage insurance, or PMI, it's going to be on your conventional loans when you have a borrower that doesn't have the 20% to put down. So it's kind of, I like to think of it as a safety net for the mortgage company in case you know, the borrower defaults on the loan. Everybody's kind of covered on that. The borrower can request it off at any time. You know, anytime they feel like they have 20% equity in the home, they can request the mortgage company take it off. For example, say the borrower only has 5 or 10% to put down, so they put that down and they're in the home for 2 or 3 years, and they see houses in the neighborhood, you know, what they're selling for. They feel like, well, our house, we probably have 20% equity in it now.
Yeah.
So they can contact the mortgage company and say, you know, we want to have an appraisal done. We feel like we've got 20% equity, and the mortgage company will have that appraisal done And if that's the case, they can get rid of it. Now, the mortgage company is required to take it off once there's 22% equity or 78% loan to value on it. They're required to take it off without any request from the borrower. And a lot of people like to think it's a bad thing. But if you look at it, it puts a lot of people in homes that wouldn't be able to get put into homes. A lot of people don't have the 20% down; they have the 5%, and you can get a conventional loan as low as 3%. You can get into a home, so it does help a lot of people out. I mean, it is an added extra cost into your monthly payment, but it does help.
Especially in today's market where the prices are going up so fast.
Right.
I've got conversations with buyers all the time where they're on the fence, like, well, should I wait to see if the market's going to flatten out or whatever? And it's and it's easy to go back and just show them the stats, like, well, if you thought that last year, this is what you would have missed out on. And a lot of times it's $70,000-$80,000. Yeah. When you look at that difference, like, because I know getting a raise of $70,000-$80,000 in a year to make that difference up, that's pretty, you win the lotto on that. Yeah. So I mean, that's a huge thing that folks need to think about when they're considering, if they want to do PMI or not, because they're not going to pay that much in PMI in that aspect, especially if the value of the homes are continuing to go up.
Yeah, and that's what I did honestly with my home. Yeah. So I mean, it's very doable. Oh yeah,
And something too, I mean, you always see the 78%, they're supposed to take it off, but it's very wise to keep an eye on it. And if, I provide my buyers whenever they buy a home, a new estimate of their home value every 6 months. Yeah. So they can actually assess that, especially if they've got that PMI, because the bank isn't necessarily they're not really encouraged to do. I mean, they're supposed to, but they're getting extra money, and it's for the bank, basically, for that insurance for the bank.
Sure. Yeah, I encourage everybody at a minimum of every year, take a look at it and see what you can do. Yeah,
for sure. And the bank's probably using property tax assessments and algorithms and stuff like that, which aren't necessarily comps that somebody's able to go into and do. So and this is one of the last points I want to talk about, unless you've got something you want to throw into here as well, is the appraisals. So we see a lot of homes out there these days where they're only accepting cash or conventional, and then when they have to be within certain criteria to be able to reach that FHA and VA standard for the appraisals. But why is a conventional loan appraisal so much easier? Trying to think of a good way to word this, because sometimes sellers get nervous about a VA or FHA appraiser coming in. So what's the big benefit of having a conventional? Because if somebody's considering doing an FHA, but they can do a conventional with only 3% down, what would be the benefit of doing that?
Yeah, a lot of times the guidelines on the FHA and VA appraisals are a little bit more stringent than they are on your conventional loan. They may be a little more picky about certain repairs that have to be done and things like that. Yeah. So that would probably be the biggest thing right there.
Yeah, and the conventional, and what Trey's talking about a little bit. So when you've got a VA and an FHA appraiser that come out, yes, they're an appraiser for the VA and FHA, but they're also looking at what's considered livability conditions or livable conditions in the home. And FHA and VA both have guidelines that they are not allowed to go through. So the appraiser a lot of times ends up almost being like a secondary inspection that happens on the home, and could end up having some more resolution that happens. And on the buyer side, you might think, oh, that's good. But in a market like this is today, sometimes depending on if there's more offers out there, if somebody's doing an exact same offer price-wise for a 3% down conventional as opposed to like an FHA on there, I've seen a lot of sellers pick the conventional just because of the ease of the loan as well.
And I've seen a lot of that as well, especially this last year.
Yeah. And an appraiser, just kind of going on the appraisers too, just because I know there's a lot of confusion on that, because appraisers don't work for me.
No, they don't work for me either.
Yeah, so the bank basically hires them. Correct. And the representations of the bank basically to make sure the bank's risk is not too high based on the value of the property, so their equity in the property and the collateral.
And I know they kind of get a bad rap, but they have their job to do, and there's a reason for them. We all know that. So.
And they've done a great job lately. I mean, it's with the market, the way the market's actually been doing lately. I mean, it's when it first started in this accelerated value phase during COVID, appraisers were having a hard time keeping up with that. And but now it seems like quite a few of them are. And I just thought of something else I wanted to discuss with you too. Appraisal gaps. Sure. So talking about that. And this is a little bit different realm. So if somebody, And this is a conversation that we have as a team whenever we do a purchase. So it's me, the buyer, and the lender that's there, and we talk about this together. And not everybody's able to do this, but in today's market, there's still some competing offers that happen. And we end up with some prices continuing to go up on the list, off the list price. And so we end up with what's called an appraisal gap. And what I like to do is I talk to my lenders and talk to them to make sure that person has the ability to actually to fund that on the other side, because that's obviously a big deal in that aspect if they end up having to pay more in cash. And could you talk to us a little bit about like how that plays out?
That kind of goes back to the pre-approval conversation, you know, and verifying that we have the funds for an appraisal gap.
Yeah.
I mean, that's the main key to it. I mean, as far as a lender, you know, we're only allowed to lend up to what the appraisal comes in at. So if we do have that appraisal gap of X amount of dollars, on our end, we have to make sure that the borrower has that money in the bank, and that's why it's always wise to go that step farther and get pre-approved rather than just sit at the pre-qualified.
Yep. That way, if you find a home that you really like, you know how much you're able to spend on it. And it's,
Sure.
And I always tell my clients, you know, because everybody, they're used to the old market where it was a buyer's market and maybe they can get it for under list price, but it really comes down to, number one, I'm going to show you the comps on the home to show you what should comp out with an appraiser going out there, because sometimes people do underlist them and they're trying to encourage that feeding frenzy that happens on there. But you know, it really comes down to how much they want the home, and if they've got the assets to do it, you know, and then looking at, you know, just the history and the statistics of the area to see what's happened in the past. And then, you know, that's a decision they've got to make at that point. Yeah. So not necessarily just like, well, this is all that I want to pay for it on the list side, because that's what it was listed at. List isn't always market price. Market price is what it sells for.
Yeah,
so
that's exactly right.
And that drives comps quite a bit too.
Yeah.
So did you have anything else you wanted to discuss today?
You know, the only thing I would add is, you know, I always encourage everybody to go ahead and get pre-qualified and move on to the pre-approval step as soon as possible. You know, a lot of people think, well, I'm not ready to go look. I'm just, you know, I'm not going to look for another month. Well, I always encourage everybody to take that step as soon as possible, so that, you know, they might know, hey, we have to save X amount of dollars over these next few months. You know, just so they can get in their mind, if I'm going to make a big purchase, I'd rather know months ahead of time how much money I need to put back, rather than just a couple weeks ahead of time.
And that's a great point.
That's a big thing I like to stress to everybody.
And you're not a debt counselor, but you can help with folks that might not have the credit score they want right now, and at least give them guidance as to what could actually help fix that.
We can put them on a plan. We can run them through what we call a what-if scenario, you know, and as long as they follow what we put out there over the next X amount of months, your credit score should go up to this score and be in good shape. So yeah, that's another reason I encourage everybody to do that, so they kind of know where they stand, and they may qualify, but maybe they can raise their score 20 points in the next 2 or 3 months. That'll give them a lower interest rate. Yeah.
And so that brings up one other really good question that I get asked a lot and that people get concerned with. If somebody were to get pre-approved, what's your typical window for that pre-approval? And then what's the process for re-energizing that pre-approval if they haven't found a home within that time frame? And how does that affect credit for them? Because a lot of folks are nervous about having another hard pull on their credit.
Typically what we do, and anymore when somebody applies, we'll do a soft credit pull first. Yeah. So it won't ding their credit. Now, it won't give us everything we need, but if they want to take that step farther and get pre-approved, then we will have to do a hard pull, and it will make a ding. As long as we can, you know, I would say it's still safe to do, even if you're going to wait 2, 3, 4 months to go ahead and do it. Just so you have that much more knowledge in your head of what you're going to need to prepare for.
Yeah, and that would be something, I mean, obviously everybody's got a different situation and you can counsel them and help them on that, but if we'll just use an arbitrary number on it, if they're cut off for the interest rate they're looking at is a 700 credit score, and the pull brings them down to a 698 or something, and they have to have that 700. I mean, that's something that, you know, would be discussed as well, you know, like, hey, just that risk versus reward kind of thing. So,
and that's basically what it is.
And that's a lot of things too that, you know, with that conversation and the communications with the team aspect, Because once you do the pre-approval with Trey, it's not just a one and done. And I'm not talking to him, you're not talking to him as well. It goes into that whole process. Even if you do fall out of that window, you haven't found a home yet, and because I've got a lot of folks that come in from out of state quite a bit, so they're only able to come in so time, and they're very, very particular on the type of home they want. But we're able to, because that pre-approval has already been completed, it's not hard to basically you're basically building off that last pre-approval to make sure nothing's changed in that time frame. So.
Yeah, we won't have to pull the credit again.
Yeah.
I mean, I believe you got to go 6 months before you have to pull the credit again.
Yeah.
So as long as we can find something within
that
6
months.
months.
And that's what I was really looking for was. So with that number, so that's why it's important to get in and start talking with him immediately when you're looking at buying, because number one, it tells you what you can't afford and what you want, and then you can kind of keep an eye and talk with Trey about interest rates, but you're not going to get locked in really until you get under contract.
Correct.
But it at least helps you plan, so you know where your limitations are when you're purchasing as well. And then, where we're able to flex and move so that when we do find a place that you absolutely love and you want to put an offer in on, we can do that and provide the ability to provide that strong team aspect. And something that I love doing when I do my offers, which is why, I end up with about a 1 out of every, all my offers I've done for my buyers, I end up usually about 1 or 2 offers, and I've got them in on a home. And a lot of that's the communication, working as a team on it, but also with the lender too. And having the lender give that listing agent a call so they're not having to reach out to them, make it as easy as possible, because there's things that are different that aren't just price-based that can really influence the way a listing agent can present your offer to the sellers, and might put us that step ahead as well in front of everybody else. So, well, Trey, thank you very much for coming out today.
It.
So you guys shoot Trey an email, give him a call on the phone, and you'll see that on your screen right there. But don't hesitate to ask him any questions whatsoever, and we'll continue this series, and we'll talk about some other different loans and niches and stuff in the future. But hope you guys enjoyed this video.
Thanks.